Andrew Wellington is CIO and co-founder of Lyrical Asset Management. It runs a US large cap value portfolio on behalf of Alliance Trust. Andrew, tell us a little bit more about how you run the money.
Yeah, so we look for three things in stock selection: value, quality, and analyzability. We look for value first because our goal is to generate the highest returns we can. And what we found is, over the long run, stocks that are value stocks that trade at low ratios, low prices relative to their earnings, have historically produced the highest returns. And then within that bucket, what we want to do is try to avoid the worst and pick the best. And to that end, we look for two additional criteria. One is quality. When we stick to companies that are good businesses amongst the cheap stocks, we tend to get a lot more of them right. Helps us avoid some of the bad ones and find some of the good ones. And the last thing, and perhaps the most important, is what we call analyzability. The simpler and easier it is to understand and dig into a business, the greater our chances of getting it right.
And how tough has it been being a value investor in 2018?
Well, 2018 was the worst year for value stocks in almost 20 years, since the internet bubble burst in early 2000. So it was really tough. But the flip side of that is we own a portfolio of companies whose businesses are doing great. If you were just to look at the earnings and the success of the business themselves, you would have no idea that 2018 was a bad year. It was a problem with the stock prices, not the businesses. And so that sets the portfolio up to be incredibly attractive as we now begin 2019.
Why can't the rest of the market see what you're seeing in these stocks?
Well, if the rest of the market saw what we saw, we wouldn't own them. The whole point of being a value investor is to take advantage of seeing opportunity where other people do not. And so this is the fate that we have for ourselves as value managers. We see things the rest of the market doesn't. And then it takes often some deal of patience waiting for the rest of the market to see what we see. There's always the worry that they won't, but by owning good businesses that are producing good earnings, eventually the market succumbs to its raw emotions of greed and seeks out where they can find these great companies and buy them at these great prices.
So how long can you be waiting on a good company or a great company until that value is realized?
It can take a while, but it usually doesn't. And so there are cycles for value stocks. There are years like 2018 where value stocks across the board, no matter what is going on inside the business, are shunned by the market and do poorly. But that is a rare exception. Like I said, a year like 2018 really last happened almost 20 years ago. So most of the time, on an individual stock, you might have to wait a while, but most of the time, the market is rewarding value stocks, and maybe not all the stocks in the portfolio are doing well, but enough of them are that in most years, the value strategy does outperform.
So what was your best performing stock of 2018 and what drove those returns?
Best performing stock of 2018 was a company called HCA, which stands for Hospital Corporation of America. They're the largest privately run hospital network in the United States. And healthcare was an area that was favored by the market last year. I can't tell you exactly why. I'm not sure it makes sense why HCA should have done so much better than many other companies in our portfolio that had similar earnings growth and success. But HCA really stood out, as did many other healthcare names, and it was our strongest performer.
Have you sold it?
We have not sold it. HCA, in spite of how much their stock was up last year, has also seen their earnings go up a lot, in part due to the lower tax rates that the new law put through. And so the multiple expanded a bit, but it's still around only 12 times earnings, which is still quite a significant discount to where the S&P 500 trades.
And what's your outlook for the year ahead for 2019?
Great question. We don't have a crystal ball. It is our view that value stocks have suffered long enough by historical standards, and there's a very good chance that 2019 will be the start of the recovery for value stocks. And for most of the 4 months that we've seen go by, that has been happening. But we don't have a crystal ball. We don't know exactly when the turn will be. It looks like it's happening already. But if it isn't happening today, we do expect it to happen soon.
But whilst you're waiting for the share prices to appreciate, how important is the dividend as part of the total return to investors?
Different investors have different views on dividends. Our view is that they're not very important. What's most important is the total return of a stock. Getting a 3% dividend yield sounds nice, but if it comes with a 10% decline in the stock price, that's a very bad total return. By seeking the highest total returns, it offers our investors the most flexibility. If they want more income, you could always liquidate a few shares. But if you maximize for total return, that gives you the best results over the long run.
So what are a couple of the stocks that you're holding today that you've got high hopes for 2019?
Well, we see the portfolio today as being the most attractively valued it's been in a very long time. And so we like all the stocks in the portfolio. But a few notable ones, one I would think of would be Adient, which happens to be our worst performing stock from 2018. Adient had some problems in its manufacturing facilities. They're the largest producer of seats for automobiles around the world. And they had some manufacturing problems last year, which caused their earnings to decline significantly. There's a new CEO in charge, and he's already begun a significant turnaround effort that's beginning to pay dividends. And we see that the performance of their factories is already on the rise, which we expect to lead to a significant return of profits back to their old level. And with where Adient is valued today, that would offer an extraordinary return for us.
That's one stock. Anything else?
Again, lots of great stocks to talk about. Another one that comes to mind is CommScope. Now, CommScope might not be a household name, but we rely on their products a great deal for communication. They make the nuts and bolts equipment that is the physical layer of our networks. So we have our fancy cell phones and they talk to fancy pieces of equipment that process those signals. That's not what CommScope does. But to communicate with a cell phone network, there's a tower, and on that tower, you'll see antennas and cables and connectors coming out of those antennas. That's what CommScope makes. CommScope last year acquired another company called Aris, and that combination is going to be very accretive to their earnings. We expect that to increase their earnings by perhaps as much as 40%. And so CommScope trades at a very attractive multiple without that 40% accretion. When they get that additional accretion, it's an even more extraordinary investment opportunity for us.
Stepping away for a moment from the stock picking opportunities, is there anything out there in the sort of the macroeconomic background that could either be a real tailwind or headwind for the portfolio in the year ahead?
We're pure bottom-up investors, and we're not positioned for any particular macro headwind. Regardless of what happens to the economy, our goal is to own the best companies at the cheapest prices. That's always the right thing to do. Now, if we have a recession, our returns won't be as good as if we don't have a recession. But we're in this for the long run, and if we don't have a recession next year, somewhere down the road there will be one, and I can't imagine a better group of companies to enter a recession with than the group of companies we have in our portfolio.
Andrew Wellington, thank you.
Thank you.